And joining me on the podcast and video, it's Russ Mould, Investment Director at Stockbroker AJ. You're Russ.
Very old greetings from the London office. How are you?
Yeah, very good. Well, is that your window or is that the virtual?
No. That's a background there. My office is my desk is actually out there. Though I am lucky enough, I do occasionally get a window seat. We do hot desk in the office now, which I must admit brings me out in hives. It doesn't really work with my OCD, but I do generally try and get the same pure if I can. Terrible creature of habit that I am.
I was going to say, if that's the view, that's an expensive office. That.
No, Mr. For all of our shareholders who are watching, no is the answer to that. That is not the view. This is a good value facility.
Okay, all right. I want to share the screen with you. Some bit of news today on well, we've got pay and employment. So if you see there, the actual average earnings excluding bonus, same as last month. So the Bank of England are looking at that, aren't they? The kind of thing. But the bonuses were up a little bit, predicted to come in 5.7, 5.9. But this is a bit of a surprise. The claimant count in May has gone up 50,000, estimated to be 10.2. Unemployment change 3 months from to April, so 140,000 above the 100,000. And now we got unemployment rate in April up to 4.4% from 4.3. I'm thinking now, surely the Bank of England are seeing the economy is slowing down, wages aren't skyrocketing. It's like that super tanker analogy where, we know the lag effect of interest rates. Surely they should start sort of, easing down interest rates, just slowly bring it down,
And we've got the next meeting on the 20th. So that's a week Thursday.
Yeah.
The ECB, Sweden, Czech Republic, Hungary, Switzerland, they've all moved. We've had 70 global interest rate cuts this year against 16 or 18 increases. So I think the direction of travel seems fairly clear that we're past the peak, as it were, in terms of interest rates. And it's now more a debate over the rate of decline. But I guess you've summarized the Bank of England's dilemma there perfectly. On one hand, inflation is still running above target at 2.3% on the consumer price index, and wage growth at 6% will be making them nervous because that will feed into services inflation, and that is harder to squeeze down than goods inflation, where you can kind of flick a switch and almost get the supply going again. So that's on one side. On the other side, unemployment troughed at 3.6% in 2022. It's now 4.4. So there is a suggestion that the labour market is slowing down. Vacancies have come down from a peak of 1.3 million to just over 900,000. And don't forget, those numbers are lagging. If you're a company, how long it takes you to go through the great process of feeling bullish enough to hire an ad, interviewing, getting the candidates in, getting them to sign, or the nightmare scenario of having to let people go, consult, try and find them something else within the firm, look after. All of those processes take time. They're not snap decisions. So those numbers, I would bet you, are reflecting decisions taken by management teams 6 or 9 months ago. So that's a big lag. So if the Bank of England are relying on that, there is therefore the danger, as you've said and we've discussed before, they're driving the car looking in the rearview mirror when they need to be setting really the cost of money for 18 to 24 months' time, not 6 to 9 months to go. So on one side, they've got inflation, they've got debt. They probably would quite like to get the interest rates down to make the government's debt more affordable and help, demand for credit from consumers and corporations, as well as make life easy for the government. And they've got unemployment. And let's face it, GDP growth isn't brilliant because it's 0 point something or other. In the middle, they've got the general election. They'll probably want to be seen to be doing too much that favours anybody either way before the 4th of July. And on the other side, they've got, this slowdown. So at the moment, you could almost say there's a scope for stagflation, which would probably be the worst case of all scenarios for investors, you could argue. So that's the balancing act that they've got. I think the last vote was 7-2 for no change. Let's see I think that's probably going to be the big indicator of what Bank of England thinking is for August or September. How does the 9-person MPC vote split down?
Yeah.
Well, and sterling's going up at the moment. So the pound, which, let's face it, has not recaptured the ground that it lost post-Brexit under any circumstances. Sterling is now at 127.30 against the dollar and about 118.30 against the euro. So the market seems to be pulling back a little bit on Bank of England rate cuts and think that it may move more slowly. And also, it won't want to move too fast and open up the spread between US rates and UK rates, because that'll just flatten sterling, and that's imported inflation for you. So again, the moment, looking at the currency markets, who are a lot smarter on this thing than I am, they seem to be perhaps slightly pulling back on what the Bank of England's going to do in terms of rate cuts this year. 1, maybe 2.
Yeah, well, look at that. That's against the euro, and for a while it's had problems breaking that 1.175 level, and
Cracked it.
now it just broke that right through.
ECB's cut, Bank of England
Yeah,
hasn't. There you go. There's an element of maths and relative expectation in changes. So it does feel as if, again, there is a little bit of a retrenchment. Bank of England, probably one cut in the autumn. Whether they squeeze a second one in before Christmas, I've seen estimates that it may now be February rather than December, but we'll see.
yeah. Well, part of me thinks that just common sense suggests like these increases in wages, and that was based largely because it takes a long time to increase wages, largely based off the inflation figures we had a while back, and now no one's going to be getting wage increases. Double the rate of inflation. So that's going to come down, isn't it? Because inflation has come down. Well,
I guess
come
you've
down
got the
the rate
national
of it.
living wage increase, the minimum wage increase filtering through. But equally, if
Yeah.
unemployment is going up, Labour's bargaining power will be weaker than it was in terms of Labour. By that, I mean employees, not the Labour Party, by the way, just to make sure we're not dropping ourselves in trouble here. So in that respect, the higher that unemployment goes and the lower vacancies goes, the less bargaining power that employees and unions have, you could argue. So again, that would by rights, you would think, start to take the steam out of wages further down the road. So again, the Bank of England, they need to try and obviously
look
they don't
ahead, like you
seem to be
said, not in the
winging it or
rearview
using their
mirror.
imagination. But half
Yeah.
the magic of it is they need to be thinking about what's going to be coming down the pipe, not what's happened.
That's the problem, isn't it? They're saying we are database. The trouble is your data is 3 to 6 months out of date.
Yeah, well, they were
So
data dependent on the. Well, they were data dependent when inflation was rising, and they were too slow then. So I think that's the danger. Is that, so that I think if you're looking for a danger, it may be that they probably hold on too long and then actually cut very quickly as
yeah.
they held on for too long and then raised very quickly. And I think that is a legitimate challenge. I mean, we've seen a lot of our customers buying 2-year and 10-year gilts in expectation of rapid interest rate cuts.
Yeah.
Because of this these tentative signs of economic softening that we're seeing. Now, interestingly, some of the rate sensitive stocks like house builders have been very strong in the past few days. That's more down to what's in the party manifestos, I think, rather than it is down to what the Bank of England's saying. Although, if you think back to 93, 94, when sterling fell out of the exchange rate mechanism, 92, 34, and the Bank of England, the Chancellor of the Exchequer, wash my mouth out, the Chancellor of the Exchequer cut interest rates, house building stocks and real estate stocks absolutely rocketed. Now, that was coming out of a much deeper recession than one we've had now. But again, if you're thinking of interest rate sensitive stocks, there might be an area to research if you think that the Bank of England might eventually get a gallop on when it comes to cutting rates.
Well, look at that. I mean, Taylor Wimpey there. I mean, previously he's hit his head on this sort of 150 level. And he's trying to get above that now. And Labour and Conservatives they are battling over house building at the moment, especially this morning. We're talking right now, and the Conservative manifesto has been broadcast by Rishi Sunak, and they're majoring on house building. But you think, don't the Bank of England, though, don't they have sort of a predictive model looking forward, or do they only rely on past data?
I mean, Ben Bernanke, when he did his review, was pretty critical of the Bank of England's forecasting and software and pretty much everything else. And that was having a friend mark your homework. So none of that was particularly encouraging in that respect. They do have models. And I think that if I was the Bank of England, I would like to say, look, we have all this data, because you don't want to sit there and have people think that you're winging it. So I can thoroughly understand why they wish to be seen to be thorough and deliberate and collegiate. But equally, their record hasn't been that good of late. And frankly, the Federal Reserve hasn't either. So I think it's nice for them to have something to say, but I think, they might just need to try and use a little bit more imagination than they've done thus far.
Yeah, that's an unemployment rate came down in January, and then it's building back up now.
It is.
Even if you look at a trend on a trend level, you can see it's come down and it's going back up.
You've seen something similar in the US. Again, not quite so dramatic yet, but I've certainly heard friends in the US and commentators in the US say that if the US unemployment rate goes to 4.2, 4.3%, and it's currently 3.9, that's when the Fed might act. So let's keep an eye on that as well.
I think there's one thing we say, it's hard to guess a month when they reduce interest rates, but I mean, it seems to me now pressure is building. Like you say, Canada, ECB, all the central banks reducing interest rates. Pressure is starting to build, isn't it? And I think
it is. And I think part of that is the debt that's in the system. That is going to really start to bite, whether it's mortgage debt, government debt, consumer. It is going to start to bite. And you're seeing it in certain areas of the US, subprime auto, for example, credit cards. You are now starting to see a rise in delinquencies, albeit from low levels, but a rise all the same. So that pressure is starting to creep in. And the other thing that central banks might need to think about, though, of course, and if you're the Fed, is that you've got a very, very bubbly stock market over there. You start cutting interest rates when there's $6.7 trillion in money market funds waiting for somewhere to go. That could get really, really quite lively. And that's when misallocation of capital happens. And that's when you really are laying the foundations for bad things further down the road, as Japan found out in 1990. So it's not as easy as it looks necessarily, but you can say, I think the question then is, did they leave rates for too low for too long between 2010 and 23? Almost certainly is the answer. And I think that's now the legacy with which they're wrestling.
Yeah, it seems to me that they are compounding the issue that they had a big hand in starting at the start. Really having it's never been so. I think this is correct. I mean, interest rates have never been so low for so long, which was down to them. And now we're going to keep them higher for longer. Well, hang on a sec. Look at the data, look where it's going, and try and predict in some way.
I know you can say there was always a reason. There was the Great Financial Crisis, the European debt crisis. There was the pandemic, so there's always been a reason, but there were opportunities to gently tighten policy when the economy was hanging in there, and it wasn't taken. And I think when the history books get written, this will prove to be a very, very interesting time. And it's certainly that's the theory that's held, for example, in Edward Chancellor's new book, The Price of Time, which is a history of interest rates. And although it sounds dull, I promise you it's not. It's an absolutely thumping good read.
Yeah.
And no, I don't know him personally, by the way.
No, I suppose is that why a little bit last few days I've noticed the FTSE 100 suffering a bit because is that because of the pound strength? I suppose because a lot of
I think a little bit of the pound. Yeah, and again we've seen that with the FTSE 100's earnings. We know that what that inverse relationship is. So if the pound goes up, it does hurt FTSE 100 earnings because 2/3 of earnings come up for overseas and vice versa. You've also got maybe a bit of interest rate disappointment, and you've got some uncertainty over the political situation. You've had the Lib Dems yesterday talking about a share buyback tax. There's talk of Labour looking at capital gains tax. So again, those cross currents are going round in the very short term as well.
Yeah. Okay. Well, Russ, I know you're going to shoot off, and it's not to catch the end of Sunak's manifesto.
No.
It's other things more important than that. So thanks for that, Russ, and we'll speak next week. Cheers, mate.